So a lot of red on the screen, as you can see, folks. Listen, there was a deluge of economic data this morning. I think the main thing you need to know is that it's all these reports came in below Wall Street consensus. In fact, the second thing that you need to know is that all of these reports came in well below Wall Street consensus. Let's start with the producer price index, folks. At 6.2%, it's fair to say inflation has peaked, right? No one's talking about that anymore. The consensus was 6.8%. The monthly decline, 0.5%. That was the largest since April of 2020. We're getting where the Fed's supposed to want us to be, right? What about retail sales? Talk about an ugly number. Back-to-back massive declines in retail sales. They said, don't worry about it in November, don't worry about it in December. Aren't those the main holiday shopping times? Well, we've got Jerome Martise and Kristen Benz both. They're going to give us a more nuanced look on whether or not the consumer is dead. I mean, if the consumer's still alive, then where are the opportunities? Of course, we're always looking for stock ideas, too, because there's always a winner in retail no matter what. And then, of course, another report out, manufacturing output down 1.3%. Again, this was revised higher the previous month. The consensus was down just 0.2%. This is a massive miss right here. Without a doubt, the Fed maybe should be thrilled, right? These are the declines that they've been trying to engineer. The question, though, is how reticent are they about staying the course, about still pounding and pounding away? By the way, real quick, want to give a shout out to Jay Powell, Fed chair, reportedly has COVID-19, but it's mild symptoms right now. Hope he stays well. Interesting, though, the market, despite all of this stuff, right, all of these are the things that we keep hearing the Fed wants to see. We were up, but we never really took off, right? So maybe bad news wasn't so good after all. Maybe bad news became the story because it's all about recession, and maybe recession sooner than later. You know, it's really tough, folks, particularly when it comes to the Federal Reserve, because we do know one thing. When recession initially sets in, it's not good for the stock market. The initial phase is tough sledding. Hey, you know what? Meanwhile, I bet you did not know this. The FTSE, this is the UK index, hit an all-time high. This despite the UK dealing with far worse economic conditions than the United States. Of course, it doesn't hurt that everyone is getting out of American stocks. These are professional money managers. They're overweight in U.S. stocks. They've had less exposure to U.S. stocks going back to October 2005. So what's going on here? The pros are selling our stocks. Our market is crumbling. European markets are on fire. Let's bring in Jim Bianco, president of Bianco Research, to help us out here. So, Jim, a lot to digest. Just your general thoughts overall on what we're seeing today.
Yeah, I think we're caught in this push-pull between the idea that, as you pointed out, the economic growth numbers didn't look good. That seems to be what the Fed wants. But underlying that was an assumption that inflation was supposed to go away. And while the producer price index was down a lot, you could put that at the feet of tumbling gasoline prices. Well, as much as I would like and you would like gasoline prices to continue to tumble, crude oil prices have started higher because China's reopening and there's going to be a big demand coming from people that are allowed out now that they no longer have zero COVID. So if we got the end of gasoline prices, we're going to be stuck in a situation where the economy might look weak if the data that we've seen continues. But the inflation data is not going to back off enough. And the fear is the Fed's going to look at the inflation data and say, can't move.
But, Jim,
even though the economy is still slow.
But here's the thing, Jim. We're always told as investors that don't worry about gasoline, don't worry about food and energy. The Fed's not worried about it. You know, that's the kind of stuff that moves up and down enough that that's not figured. They don't put that into their rationale. So is there some other component today, something else about today's action that suggests either maybe the Fed's going to just make a mistake? I mean, this is what I'm feeling, that the market is saying, hey, we just don't trust the Fed to see the writing on the wall whenever it's clear enough that they'll put on the brakes.
Yeah, no, that's been that underlying tension all year, that the market has been worried that the Fed has been making a mistake by being so aggressive in raising rates. And the market, I guess it really comes down to the Fed is uber focused on the inflation data. The market seems to be uber focused on the growth data.
Right.
And that explains the difference between the two. And we can't quite square it. So, yeah, the market is very worried that the Fed might be making a mistake. just because it is doesn't necessarily, I'm not trying to defend the Fed, but
Sure.
it doesn't necessarily mean that they're going to make a mistake. They could very well be making a mistake. But that's why you get this confusion and this volatility.
As we have this conversation about the stock market, the bond market reacted right on cue. I mean, the 10-year yield came down tremendously. So let's face it, 340, that is the magic number. You go back here, it was sort of resistance. Now it's sort of support. We actually dipped under there. I think this is your pivotal swing point. If we start to get really below this number, it's hard not to imagine the stock market going up. Of course, if it holds, that could be bad news too. How do you see this coming out?
I agree with you that we're at that level right now where the bond market is, if the next move down could be significant, if it fails to move down and holds this level, that could be significant. It's a pivot point right now. And this is really, in my mind, the first one we've seen maybe in a year where the bond market is at that juncture where it could be. I tend to think that yields, I've been biased towards yields moving higher for a year, and I still am biased towards yields moving higher. If I had to guess, I think we will hold roughly in this 340, high 330s level, and we would see rates move higher. But given that it's such a pivotal level, if I'm wrong on that and it keeps moving lower, I do think that that should be respected. It's an important juncture, and it would be an important move.
All right, Jim, I appreciate you. Thank you very much, my friend.
Thank you.
All right, folks, let's bring in Cal Bond Capital Management.